by the end of this video, you're going to be able to understand market structure, your supply and demand, your liquidity, and also get to execute trades on the 15-minute time frame that are profitable, that you can use to pass your prop firms today, guys. So without wasting any time, let's get into the screen so that you can start learning, guys. So firstly, market structure usually looks like this. So you have your higher highs and your higher lows. So this is called an uptrend, guys. Now, for those who don't understand market structure, it simply means that the market is pushing up, creating your lower low here, and then we have your high, and then you have your higher low, higher high. Then whenever you have a higher high in the markets, that is called a break of structure, guys. Now, and then a break of structure simply signifies that the market is strongly pushing to the upside, and then buyers are in this market, and then sellers are just a retracement to tap into an area of interest before we can continue pushing to the upside. So whenever you have a higher high here, you have a break of structure. So what happens is that the market has to pull back, and then this pullback here is called an internal structure, guys. Now, or the order flow of the markets, just because we need a realignment here on the lower time frame so that we can tap into an area of interest or an area of demand before we can look for those buying opportunities. So what I like to use is my Fibonacci tool, guys. And for those who didn't get my settings, I can just double click it so that you can get the settings. So we have your 0, your 1, your 0.71, and your 0.79. And then the 0.71 and 0.79, this is the area that I like to use, and I call it the golden zone, just because whenever the market taps into this area of interest, that is when it will push to the upside very nicely, guys. Now, so let me just remove this here so that we can continue with our lesson here. So we have your higher high, then the market tapped into an area of interest, and then for you to use your Fibonacci tool, you have to start from the low to the high. Then that is when you're going to get a clear entry or a clear area of interest. So let's say maybe we have an area of order block here or an area of demand. So whenever the market taps into or surpasses this 0.5 zone here, that is when you can start drawing out like your supply or demand or order blocks, however you want to call them, guys. It's the same thing. So whenever the market taps into this area, you switch to the lower time frame. So for example, let's say maybe you're on the 4-hour, what you need to be using is the 15-minute time frame to look for a realignment, guys. And then a realignment is just an internal structure, market structure shift, guys. So let me just remove this here, and then we continue with our analysis. So you have your lower high here. Then after having the lower high, the market tapped into the area, then it started pushing up, breaking the previous high just like that. And most of you, what you don't understand is that this is your lowest low here. This low is protected and this high is weak. So this high here is weak, guys. The market has to take it out for you to take your profits. So this low here, if this low gets broken, then that is when we have a change of character in the markets. So we are no longer going to look for buying opportunities, but instead look for selling opportunities. So let's say you have your change of character like this. What you do is you look at that higher time frame structure, and then you use your Fib tool. Now we are going to use the high. We are no longer using the low like this. Now we are going to use the high to determine our area of interest. Then that is when the market will tap into a 50% order block or a 50% supply. Then that is when you can get to sell. And then whenever we are in this golden zone here, that is when the market will react very nicely. And then obviously your stop loss just have to be above the previous high, just like that. But like if you are an aggressive trader, you can just use like tighter stop losses, but like that is if you know what you're doing in the markets, just because if you are wrong and you're going to take like a lot of losses before the market goes in your direction. And I'll do some analysis or structure mapping. We're just going to do some structure mapping before the end of this video. Do stick around for that so that you can also learn how to do your structure mapping, guys. Now, so let's say maybe we tapped into an area of demand just like that, and I like to do my things very simple, whereby each and everyone here that gets like my markups can understand like what's going on. So let's say maybe we had that break just like that. So after having this break of structure, what should happen? The internal order flow has to come up, guys, which means that this will be your internal market structure shift, then the market will just push to the downside, creating those lower lows and lower highs. And I'll show you what I'm talking about. So let's say maybe we had this high here. So this high and this low here, it's your trading range. And a quick tip that you can use is just use a line from the low just like that and then to the high. Then you know that everything that is happening within this area here is just internal up until we break this low here, up until we break this low here, or we break this high here. So we are still looking for those continuations to push to the upside, just because the market is obviously pushing to the upside, creating higher highs and higher lows. So obviously this should be your lowest point and to your highest point, just like that. So let's say maybe the market surpassed this area of our golden zone. What will happen is that it will respect an area of demand at the lows, just like this. This low is still protected, which means that you're looking at the internal order flow here. As you can see here, we had a high, a low, lower high, lower low, which means that that is your internal change of character. Then after having the internal change of character, you have your lower high, just like that, lower low, lower high, lower low, lower high, lower low, lower high, lower low. And also using the 3 candle pullback, guys. Now whenever I get to determine if like this is a pullback, let's say maybe for example, and everything will be shown to you on the charts, guys, now obviously. So let's say maybe this is your high, then this is your low here. You need a 3 candle pullback. Let's say maybe your bearish candles, they should be 3, guys. Even if like you have one here, let's say for example, then you have a bullish candle like just like that. Then after having the bullish candle, then comes a bearish candle again, then comes another bearish candle. This is a valid pullback, guys. Now that is a valid pullback. What you need to understand now is an area of interest, then switch over to the lower time frame. Like I said, this example is based on using the 4-hour market structure, guys. Even on the daily, it's the same thing. You're just looking for the same thing. Then after that, we have your change of character or a market structure shift. And then after having that market structure shift, that is when you're going to look for buying opportunities. And most of the time, the market will just take time, guys, doing its things around the area of entry, and then after that it will just commit to the direction that we are looking for. Just because you've analyzed, you've done all the things correctly, now you're just looking for an entry. So let's say maybe this is a change of character, then the market has to pull back into that area of demand. Then let's say maybe this is an area of demand, then that is when we start looking for those buying opportunities, guys. Now so I'll show you like on a bullish, this is a bullish example, but like also on the bearish example, it's the same thing. You look for areas of interest, you look for the market structure. But like, let me just show you quickly, guys. Now so let's say maybe the market is selling just like that. So you already know that this is your high, lower low, lower high, lower low, which means that this is your break of structure within this point. And after having a break of structure, obviously you just need your fib tool from the high to the low. Then you get to determine your area of interest or your supply area in this case. Then we tap into this area of supply, then the market continues to push to the downside, having a new break of structure just like that. Means that this is your previous high, this is your previous high here, and then this is your new low, which means that that is your trading range. From this high to this low here is your trading range, and then whatever happens within this area here is just internal, guys. Now even if you get like a break of structure here, does not mean that the trend has already changed, whereby you are no longer looking for sales but instead looking for buys. No, it's still in a bearish trend, guys. Now still in a bearish trend. You're just looking for that market structure shift. The market has to take out the liquidities, has to fill out all the imbalances, all those things. Then after that is when you can look for a market structure shift just like that. Then after getting that market structure shift, that is when you get to determine your area of interest. Then let's say maybe this is your area of interest around that point, then the market has to pull back into that area. That is when you're going to look for sales at the top of the structure just like that, targeting the previous low, just because we're looking for sales, which means areas lower lows are just weak. We are targeting those lower lows just because they are weak, guys. Now so let's look at a trade that I didn't take, just because I don't take as much trades as I usually did. So let's look at EuroCAD. I think EuroCAD was the best example that I can come up with. Let me just check. Yeah, this is EuroCAD, guys. Now, so as you can see on EuroCAD, guys, we can start over on the daily time frame. And let me just remove this line here just because I was determining areas of interest. So we are focusing on the current market structure, obviously. So as you can see here, the market was creating higher highs and higher lows. So we had this high, low here. Let me just use this marker here. So we had this high, low, then we had a high, then we had a low, then we had a higher high using the 3 candle pullback, guys. As you can see here, this is not a valid pullback. We had only a bullish candle, 2 bearish candles around here. We didn't have 3 candles or three bearish candles, guys. Now, so we had a higher high here, then we had a higher low around here, then we had a higher high, then the market took out this low here, which means we have a change of character. So this is our new lower low. Then after having a new lower low, we have a trading range from this high to this low right there. The market tapped into an imbalance, and then we have your lower high. Then after having a lower high, we expect the market to drop to the downside, give us a new lower low just like that. Then after having a lower low, we expect that the market has to respect some type of an area of supply around here. Then that failed just because the market does whatever it wants to do. We just have to follow what happens. So after having the lower low, the market changed character again, having a new higher high just like that. So after having that, we have your new trading range from this low here to this high. That is your trading range. So up until the market taps into an area of interest, then decides to push to the upside, that is still your trading range. So that happened, the market pulled back into an area of interest around here, broke structures, so which means that this is your new high, then this is your new low around that point. So around this point, we also had liquidity. As you can see, the market drilled to the downside up until it taps into this extreme demand zone around here. Then after tapping into that extreme demand zone, we took out this liquidity here, relatively equal lows of the liquidity. Then we switch over to the lower time frame, let's say maybe the 1 hour, just because we were looking at the daily time frame. So after tapping into that area of demand, you can obviously see that this is our high that we talked about, and this is our lowest point. This is the liquidity that we have, this is the demand zone. So this, everything that's happening here is internal. As you can see, we had the high here. Let me just remove this here. So we had the high here, then we had the lower high here, so which means the market was changing character internally, guys. Now low high here, lower high, low higher high here, and then we have your lower high, lower low here, lower low here, lower high, lower low, then we have your lower high. Then it seems like it happened to have like equal highs, if I'm not mistaken here. So let me just zoom in, just because I need everything to be perfect, guys. Now even though I'm stuttering, it's because I've been talking for quite a while. So as you can see here, we had a break of structure, obviously. So it means that this is our low here, and that is your trading range, obviously, from this high here to this low here. That was your trading range. But like, as you can obviously see, the market tapped into it, and after tapping into it, we just wicked through. And the reason being is because we had liquidity around this point. So this liquidity here was the reason why the market went a bit to the upside, and then on the lower time frame, it gave us a change of character. And the reason why I'm showing you these things is because you can also trade like the internal market structure up until we tap into an area of interest, guys. Now, so as you can see here, we broke structures around here, then the 3 candle pullback. As you can obviously see, we had 1, 2, already 3, guys. So this is your lower low, which means this is your lower high. Even though we didn't tap into an area of interest, then we had a break of structure around here. So after having the break of structure, which means that this was your lower low, this was your lower high, tapping into an area of interest around here. So this is a fair value gap, obviously. So the fair value gap right there, and after tapping into the fair value gap, it means that this is your new trading range from this high to this low here. From this high to this low here. Then we tapped into that area, then we pulled to the downside very nicely, which means this was your new lowest point. this one here, let me just change the color. This was your new lowest point, and then this was your highest point. So what we are looking for right now is because what we are looking for right now are buying opportunities or a change of character, just because we tapped into the demand zone. We have a trading range, so which means we're just gonna wait for the market to take out this high here. That is when we're gonna look for buying opportunities. So we tap into it, then we have a change of character. Then before having a change of character, guys, you can obviously see that the market pulled to the upside, creating those higher highs and higher lows, just because we have your high, your low, break of structure, high, low, then we failed to break, creating a lower high, then we had a lower low, lower high. We tapped into this area of demand here after having that break of structure or a change of character, just because we had liquidity around this point. So after taking out the liquidity, that is when the market committed to giving us another change of character around this point here. So after having that change of character, the market tapped into this area here, and then that is when the market pulled to the upside very nicely, guys. So that is how you do your market structure, guys. Sometimes it may be a bit confusing, but like whenever you do it, like constantly sticking to one strategy whereby you just stick to your supply and demand or your market structure, doing the same thing over and over again, that is when you'll get to learn more about the strategy. That is when you'll get to learn how you can maximize your profits using the same system, just because this strategy is very systematic, or this concept is very systematic to a point whereby you have a step-by-step rule. Even your trading plan can be very simple. Let's say maybe you're looking at the 4-hour structure. The 1 hour, you look for your liquidity. Even if you don't find it, you go to the 15-minute time frame, you look for your liquidity, you look for your supply and demand. Then that is when you get to execute. And this was just to show that market structure can be very simple. That is if you keep it simple to yourself, guys. So that is it for today's video, and I'll see you on another one, guys. Peace and love.